Now, there's a chart which I downloaded from the TED database at the conference board, and about 3 weeks after I downloaded this chart, it disappeared. I don't know if it disappeared for political reasons or it disappeared because the data was wrong. So I just want to say that this may not be correct, but it was published. And it's consistent, at least for the advanced economies, with the actual data that's coming out of the conference board now. But this chart shows you global productivity growth, and what you see, and the only reason I'm using it is because of this blue line. If you see, back in the 70s, there was this big debate about why has productivity growth stalled in the advanced economies. And that's the discussion of why it went from there to there. Then the debate, we never did work it out, by the way, but I'll come back to that. And then you have this period where productivity growth was okay. But you can see at the end now, for all countries, we've gone to zero productivity growth. Australia's actually just started to turn up again. What's interesting about this chart is you can see the reforms in China from the 80s to the 2006, a massive, massive increase in productivity growth. But for some reason, since the financial crisis, even the Chinese data has started to show the same trends as the advanced economies data. So if this is real, this is a big concern for the global economy. What does slower productivity mean? Well, it depends if you think it's temporary or permanent. If you think it's temporary, then eventually there won't be a problem, so the existing capital stock is okay to service future demand. But if you actually think that this is permanent, then when you're looking out into the future, the amount of demand is going to be much, much lower than you thought. Your capital stock is now too high, and so you stop investing. And one of the characteristics we're seeing in most economies at the moment is that private investment has stalled. Companies are sitting on vast amounts of funding, government is giving away money for free, but firms are not investing. And the question is that because they actually have revised their future, they think the world is no longer growing, or is it just a temporary change in risk? It's really hard to know right now. But if it is a permanent loss of productivity, then we're going to end up with a massive crash of investment. And again, given current world interest rates, probably even lower real interest rates than we see today. And so this is an interesting discussion. I don't know the answer. My guess is that it's actually higher risk, not lower productivity, that's actually driving what we're observing. So now let me just summarise the global economic outlook. What does it mean right now? Well, this chart might be a little bit hard to read. What I have here is 4 different versions of the World Economic Outlook from the IMF. Now this purple lines, they're the latest ones, and so this is history. So this is what the world economy looks like. This is what the Great Recession looked like. And then we see that when we get out to 2016, this is the latest forecast. If you step back, the green line was the forecast that was made in July 2014. The red line is the forecast that was made in April 2013, and the blue line is the forecast that was made in July 2012. So if you look at what the IMF has been saying, they kept forecasting a very rapid recovery, and then a not quite so rapid recovery, and then even a less of a rapid recovery. So the IMF has been continuously getting it wrong, as has all the other forecasters, not because they can't forecast, because this is not a normal business cycle upturn. This is an upturn that's been, as I argued at the beginning, has been driven by a very large structural problem that hasn't been fixed. And so if you don't fix the underlying problem, when the economy should be turning around, it doesn't, because you've still got the structural impediments preventing growth in these economies. So this is a picture which will probably continue for some period of time below expected growth. So if you're looking then at what's happening in the world, the US is likely to grow strongly. And when we model the US over the last few years, the energy boom has been a significant driver of economic growth. The US has reformed the financial problems that came out of the Great Recession. Japan has started on their process of adjustment, and I'll touch on that in a minute, but they've only done one part of the program. They've flooded the economy with money, they've brought down the exchange rate, but they haven't tackled their high debt, and they haven't tackled their low population growth. One of the big issues that we face now is that the global monetary relaxation that's pushed money into the economy has actually driven up asset prices rather than driving up investment, which is a very bad thing, because if investment had risen, the supply side would have responded, so there would be enough supply to meet demand. But if you're driving up asset prices, all you're doing is having capital gains, which will eventually lead to a bubble situation. So then let me drill down a little bit deeper into some of these issues. The big question in Washington right now is how can the Fed pull out of the monetary stance they currently have, which is zero interest rates, and guide expectations that this is not going to blow up the bond market. And I actually think the US can do this. I think the US can actually start to raise interest rates in September. They've been very clear and transparent about the mechanisms for doing it, the path that they'll follow. The problem's not in the US. The problem is in the rest of the world. And I'll talk about that shortly. For Europe, the big problem is how do you stop the euro from falling apart, either because of a banking crisis or a sovereign debt crisis. So I wrote this slide a few weeks ago before Greece. Greece was obviously the key problem, but it's certainly not the only problem in Europe. In Japan, you've got the three arrows policy, which I've touched upon, a massive monetary expansion, which brought down the yen, a stimulus in the fiscal accounts, but then a long-term fiscal reduction, which requires increasing consumption taxes, which has been postponed, and then some way of raising long-term growth by increasing the labour supply with a focus on female participation. And there's been some move towards that, but nowhere near enough to get Japan to start growing again. In the emerging economies, this is where I think the big question of the end of QE comes from, because as the US starts to raise rates and as capital flows out of these economies, you'll start seeing who's wearing what in the swimming pool. So as the water level goes down, some countries are going to be exposed. And so this is a big problem from a risk point of view. Capital flight will be a serious concern in some of these economies that have actually wasted the opportunity of cheap credit. And we always have China, big structural reforms needed on the environment, on pollution, particularly in the cities, on financial reform. There's a lot of work happening in China which is causing a lot of volatility in markets, as we've seen with the recent stock market change.